We've got a great turnout today. I think it's because it's the topic du jour. Armand over here has done me the favor of taking over the hard part, which is the introductions and things like that. But I just want to say it's great to partner with AllianceBernstein. Thank you guys for your help with this and for your ongoing support. Also, if you need CFP or any kind of CE credits, they have been very generous in making this compatible for that, and the forms that are necessary are on the front desk. So if you need that, pick up one of the forms at the front, fill it out, and we can get that processed. But without further delay, I'll hand it over to Armand.
Thank you. Appreciate it. Thank you so much. All right. I think that stuck. All right. Good afternoon, everybody. My name is Armand Damrett, Regional Manager with AllianceBernstein, based here in Richmond, Virginia. Really appreciate you having us join your session today. Today, I'm joined by Brian Resnick, who's also going to be doing the hard part for me, who is a Senior Alternative Strategist, Chartered Financial Analyst with AllianceBernstein. For those of you who are not familiar with the firm, we manage about $800 billion in assets, of which roughly $80 billion is in alternatives, private investments. So today, he's going to take some time to dig through one of the presentations that we get a lot of demand around that he and his team built on demystifying private credit. So we're going to start with the origin of the space and what's created really robust growth, significant amount of opportunity on the back of increased regulation on the banks, and an opportunity for investors to provide liquidity and lending to the marketplace and extract a premium for doing so. From there, we'll pivot and we'll talk about which parts of private credit have really garnered a lot of attention, but then other parts that have been overlooked that, in our opinion, create a more attractive risk-reward profile that are also backed by hard collateral. Along the way, if you have any questions, please interject. We want this to be conversational. If there's anything that we miss at the end, we'll certainly be taking questions as well. We have the forms for CE credit for CFP and SEMA, so if you need that, definitely grab one of those forms. I could bring one to you. And maybe we have something special at the end, we'll see. But I will hand it over to Brian. One last thing before he gets upset with me. I also have Joe Dominguez, who is our family office RA specialist covering the Southeast, so he's here as well. We'd love to meet everybody in the room at some point today. All right, thanks so much. I'll hand it over to you.
Thank you, Armand. All right, thanks everyone for being here. I don't know, is this on? Oh, is that just for you or is it for everybody? Okay, great. Well, I don't think I need a mic. It's a small enough room, but it's great to see everybody. Thank you so much. Let me start my little timer here to make sure whoever wants CE credit gets enough talk time to get the CE credit. The reason we created this presentation, or we created the Demystifying Private Credit, is that one of the things that bothers me most about our industry is how much we try to make things that are not particularly complicated more complicated. And I feel like throughout my career, a lot of the firms I work for feel like there's some sort of benefit to making things more complicated. And private credit is just credit, and we're all familiar with it. It's just a slightly different flavor. And so the purpose of this presentation is to demystify private credit and talk a little bit about, as Armand said, where it came from, where we think it's going, and some of the different ways that you can access it. And I see that I have a clicker here. All right, so I think, if we think about private credit 1.0, we think about, direct lending, as it were, right? And usually, when we think about private credit, direct lending is what we associate it with. Now, for those of you that have invested in private credit or seen a presentation like this, some of this might be a little bit of a review, but I think it's nice to set the table just so we're all kind of playing from the same place. So private credit is really all about, at its essence, regardless of what flavor of private credit, about private markets stepping in where banks are stepping away. That's really what it's all about. It's about private markets stepping in to areas where banks are stepping away. And private credit is not the first market to step in to serve underserved borrowers that the banks were not serving well. And I was actually just talking with someone about the late 70s and some of the issues in the economy around rates and inflation. And actually, if we start at 79, what we see is this kind of multi-decade trend of bank consolidation. These are the number of banks in the US that were at about 14,000 back then. We're now at about, call it about 4,000. It's actually smaller than that now. It's closer to 3,500. And we see this continued bank consolidation happening as we've gone through multiple periods of crisis, of challenging rate environments, and of regulation. I'm not going to take you through the entire history because that could be a whole presentation right there. But just to give you a sense, in the late 70s, you had interest rates were really high, inflation was high, banks were actually regulated in terms of the amount that they could give a depositor. And so depositors were looking for higher levels of interest rates. Money managers started something called the money market mutual fund. They needed to do something with that, and they financed the underserved commercial paper market. So a lot of instances in which our business comes along, takes investor money to then go invest in some of these markets. High yield corporate bond market is an example of, again, an underserved market by banks that the markets are coming in to support in the 90s. We have securitized markets in the 2000s. And then, of course, private credit shows up really post-2008, post-crisis, to begin to fill a gap that banks are not meeting. A great way to see the diminishment in terms of the bank's role in lending the economy is by looking at corporate levered loans. These are just high yield loans, effectively, to companies. And you can see that banks in the US represented about 72% in 94, and they're only about 25% today. Actually, they're closer to 20% now. So we've really seen banks, still critically important for lending in the overall economy, take a much diminished role. So again, still at the center of lending, but supplemented by these other markets that are effectively coming in and serving underserved portions of the borrowing market. So let's zoom in a little bit on private credit. So what happened that caused private credit to explode in the post-crisis era? So this is the investable private credit universe, which you can see was kind of a nascent market. I don't know if you guys can see it on this side, kind of a nascent market up until 2008. And what happened in 2008 is we had a financial crisis where banks were naturally restricted in terms of their balance sheets. But more importantly, in 2010, 2011, you had Basel III in Europe come out and Dodd-Frank in the US. And so if you lived through the financial crisis, which I imagine most of us did, then you remember Dodd-Frank and all the regulations that really came to effectively shore up the banking system, to make the financial system safer and more stable. And it worked. They were great regulations. But part of what they did was force banks to step back from riskier types of lending. One of those types of lending was lending to private equity sponsored companies, right? So private equity, just to take a step back, today we're talking about private credit. Private equity companies effectively use tremendous amounts of debt to go out and buy companies and then try to profit off of that purchase. Historically, they got that debt from banks. After the crisis, the Dodd-Frank regs basically said that they could no longer do this. And as banks stepped away from this business, we see the birth of the modern private credit markets. And actually, if I go to this side, you can see that the size of the private credit market is about $2 trillion. High yield market's about $1.7 trillion. So basically, the private credit market is effectively the same size, or a little bit larger than the US high yield market. Now, you'll notice that there's a blue line and a yellow line. The blue line represents corporate debt, direct lending, the sort of what most people think of as private credit, lending to a private equity sponsored company. This yellow bar are more asset-backed or asset-backed style loans. We'll get to that later. The one thing I just want to point out is that if you look at the asset-backed piece, it's sort of where direct lending was in 2010. And as we'll talk about later in the presentation, we think that this actually overtakes the blue line over time. But let's stick with direct lending for a minute. So why has this become such a popular investment for so many folks? How come you hear so much about it in the news? Well, there's a few reasons. Number one, it enabled investors to diversify into a different part of the economy that they were historically not invested in. So when we talk about direct lending, the focus is really on the middle market. This is where private equity firms fish. And the middle market consists of 200 companies from 10 million to a billion. It really represents the middle third of the US economy. So companies that are not typically big enough to be in public markets, and employs 48 million people. So one of the first reasons that this became interesting to investors is just for diversification. And any sort of alt, as it were, I don't really love that term, is meant to bring diversification. And so that's one of the things that this brought to a lot of investors. The second thing it brought is a pretty interesting pickup in yield. Now, historically, the yield pickup over high yield for private credit is something like 3%. This is where it stands today at about 1.5%. So there's no doubt that premium has come down. It still exists. But higher yields and lower loss rates. So if you think about private credit in general, one of the major benefits of private credit as opposed to public credit is that these are privately negotiated deals. Why does that matter? Well, it matters because if you're lending money to a company, you can negotiate the terms in terms of your recourse if they default, in terms of what constitutes a default, in terms of making sure that they have the right metrics in terms of cash flows. You can really put some strong covenants to protect yourself in place. In public markets, you can't. You're just a deal taker. You buy the bond at whatever price and whatever covenants or really lack of covenants are associated. And so as a result, again, you get a higher yield, but you also get a much lower loss rate. So we see that defaults are lower and recoveries are higher because of this private negotiation. And so with higher yields and about a third of the default rate relative to high yield, naturally what you end up with, and this is going back to 2008, really the inception of the asset class, is significantly higher returns with lower volatility. So 8.3% is outperforming core bonds, high yield, and equities with volatility that's about 2/3 of high yield bonds. So this is the reason everyone is so excited about private credit, because it's had great returns. I mean, how could you not be excited about it? One of the things that investors are a little bit nervous about, and I think rightly so, is that private credit right now, as we saw a moment ago, spreads have come in quite a bit. So they're about half of what they were, on average over the past several decades. And, you're not going to see a lot of managers that sell private credit say this, but, the truth is that covenants have gotten a little bit lighter. And so does that mean that this is not a great asset class? No, it's a fantastic asset class. We think it's a great strategic asset class, but a lot of money has chased it, and there's no doubt that it is getting to be more competitive. So what folks are asking is if they're in this space and they want to have this experience again, is there another market that's forming that would be interesting to get into? Or, is there something, if they haven't gotten into this market, a lot of investors often ask, well, is it too late to get in? And we would say it's not too late to get in. However, we're in the very beginning innings of what we think of as private credit 2.0. So this is what we think is effectively going to be the next wave of private credit. We're already beginning to see it. We think it may very well be larger than direct lending. And right now for us, it's a rather compelling area of the markets. Again, we do both asset-backed as well as direct lending. We think they're both great assets. But this is an area that we're very excited about. And so again, we're not necessarily biased, but this is our views that we're talking to our own clients about. So what is asset-based lending or asset-backed lending? If you've picked up the journal lately, you've probably heard about asset-backed lending. It's one of the hotter topics across institutional investors these days, and it's making its way into retail. It is quite, at its simplest level, investing in bonds or making loans against income-producing assets. Right? So what does that mean? Well, you can do it commercially, or you can do it on the retail or consumer side. On the consumer side, it's things like automobile loans, where you have a loan and an asset backing your investment. So you have income from the loan and again an asset behind it. Housing, which could either be mortgages or construction loans. So again, you have a loan with an asset behind it. Consumer loans, as in point of sale loans. You go to the jewelry store and you want to buy some jewelry and finance it. That would be another example of an asset-based consumer loan. And then things like power sports. So, boats and RVs and ATVs. Really, any big purchase a consumer is going to make can be financed. And effectively, that is one of the largest areas and one of the most quickly growing areas within private credit is private credit financing effectively the consumer. There's also an industrial side of this. So commercial real estate loans obviously have an income-producing asset that is ultimately backing your loan. Aviation finance, which actually, even though it's not technically credit, is considered to be part of the asset-based finance or asset-backed credit, which is quite literally buying and leasing out airplanes. It's kind of a bond proxy. You end up with a lease that has the contractual income and own the airplane, which is the asset behind your investment. And then energy transition, a lot of infrastructure lending, but this is an area that's really big right now. We did have a ton of policy support in the US. It's mixed right now. Europe's still a lot of policy support. Nonetheless, the amount of energy we need in the economy is so large, especially given the increased use of AI and data centers, that it's clearly going to take a mix of all types of energy. So energy infrastructure is another area where, again, you're financing an income-producing asset. Importantly, all of these sit in SPVs. So one of the benefits of asset-based lending is that it doesn't sit on the balance sheet of a company. So if for instance, any of these assets stop paying, there's no recourse against the company. You immediately own all of the recovery, right? You own the asset because it all sits in an SPV. So they're credit remote, which is really unique for this space. Let's go through a couple of the differences between asset-backed and corporate debt. So corporate debt, as I said a moment ago, is backed by corporate cash flows. You make a loan to a company and they promise to pay you back, right? It's based on corporate cash flows. That's it. If they don't have the income, they don't pay you back. Asset-backed, again, is based off of cash flow producing assets. Doesn't matter what any company's doing, as long as that asset, whether it's the pool of consumer loans or it is an airplane lease, as long as that asset is generating the income, you're getting paid. Even if a company's operating that asset, doesn't matter what happens to that company's income. All that matters is that the asset is producing income. Uncollateralized corporate debt's uncollateralized. Asset-backed, by definition, is typically collateralized. You do have some unsecured consumer debt that is typically lumped in with that. So we often say it's collateralized by hard assets or financial assets, but it is typically collateralized. Another really important point of differentiation between corporate debt and asset-backed debt is that corporate debt is bullet maturity, which means that you get paid, a coupon and all your principal at the end, whereas asset-backed debt is amortizing. So you get principal and income paid down at the same time, which means it's de-risking. Right? If you think about it, when you lend to a company, all your risk is in your principal is there the entire time until you get paid back at the end, as opposed to asset-backed debt where you're getting principal throughout. So it is actually de-risking over time, and the fact that you have an asset behind it, means that you're getting more equity in that asset, right? Or there's more equity in that asset. So your recovery's higher, your default's lower, and you're de-risking over time. This is why this is such an appealing space. Key sectors, so direct lending is really the key private sector within private debt on the corporate side. This is typically synonymous with direct lending, but you do have special situations in distressed debt. That's a pretty small portion of the market. The key sectors on the asset-backed side would be consumer debt, residential real estate, commercial real estate, and hard assets and infrastructure, as we just mentioned. And I think something that's really important to recognize that both of these have public market equivalents. So on the public bond market, corporate bonds and collateralized loan obligations on the corporate side, and then effectively securitized markets on the asset-backed side. So, each of these markets has a public market equivalent, but really for the first time, we're beginning to see opportunities in the private market in the asset-backed debt side. All right, that was kind of a little bit heavy, but that was the primer to sort of set the table for where things are going. And remember what I said before, that private credit is all about private markets stepping in where banks are stepping away. In direct lending, it was really about private managers stepping in by themselves to finance private credit, literally going out and finding companies to lend to. With asset-backed, it's a little bit different. So we've seen something really interesting, call it over the past 10 years. We've seen the rise of what is known as specialty finance companies. Just out of curiosity, how many people here, by show of hands, have heard of specialty finance or specialty finance platforms? Right, just a few of you. Okay, all right, so this is getting more popular. If I asked that question a year ago, it was like no hands. But now, obviously, money managers are out there pitching their asset-backed funds. And we're hearing a lot more about this in the marketplace. But for those that are less familiar, specialty finance companies are just non-bank lenders to consumers and small businesses. That's it. They're non-bank lenders for small balance loans. So it used to be that if you were going to buy a car, Ford Auto would finance your car, or perhaps the bank. Now you have, if you go to buy a car, you have a lot of these dealers will go to the back and they'll look on their computer for the lowest possible rate. They're not just looking at banks and their home office or their financing company. They're also looking at specialty finance companies. These are companies that have come along and utilized big data, utilized the fact that they don't have brick and mortar, utilized AI in order to compete with banks to make loans at lower rates or find ways to get better performance out of different segments of the loan market. And they finance everything from automobiles to jewelry to homes. I mean, you have online mortgage lenders at this point. So think of your online or point of sale lenders. And you have really this massive growth since 2008 in particular, as banks have become more restricted, in these non-bank lenders. And they're actually about $6+ trillion now, and they're headed to be about $10 trillion. This is a massive market. Now, what's interesting about this space is that even though banks have sort of stepped away from loans that are considered riskier because it's problematic from a regulatory perspective, they've still participated in these markets by lending to these companies. So effectively, these companies started out by borrowing from banks. So banks would give them like a bridge loan, which is low duration, high quality bridge loan to a company. So from a bank's perspective, not very risky. These companies would take that bridge loan, go out, make a bunch of consumer loans. Then they would securitize it, sell it off into the market, and pay back the bank. And this sort of went on for years as these folks grew. But what we've seen more recently is that, with the capitulation in small banks in the US, with new regs in Europe, we're seeing banks really begin to pull back from this market as well. And now these specialty finance companies are turning to private credit and effectively creating what I think of as new banking. Some people call it other terms. But I really think about this as sort of a new model to take over for what banks have historically done. So banks, again, use their own balance sheet to originate loans. Now you have two organizations in sort of symbiosis. You have private credit investors and specialty finance origination platforms. And basically, private investors provide the capital to these platforms. These platforms go out and they make loans to small businesses and individuals around the world. And then instead of securitizing them, they literally hand the loans over to the private credit investors. So you have one company that is the origination and servicing platform. They originate and service the debt. And you have private fund investors that are supplying the capital. The private fund investors get interest and principal and any sort of recovery if there's defaults. The specialty finance platforms get their origination fees. That's how they make money, is they originate debt and they service the fees. And so effectively, this relationship between private fund investors and specialty finance platforms is really becoming one of the largest forces in consumer finance today and is changing the face of borrowing. And we're at the very beginning stages of this. But again, as you saw a moment ago, we expect this market to reach call it close to $10 trillion and dwarf the corporate credit market. And this is why private credit investors are so excited about the opportunity. And you just see more and more money pouring into this because, on the other side of that are some pretty heady yields and returns for investors. So if you think about where we were a decade ago with direct lending, you had this massive need of borrowing. Banks stepped away. Private markets step in. We're seeing that again with asset-based finance and consumer finance in particular. Banks, importantly, are still a massive part of this market. So if we look at some of the biggest areas within asset-based finance in the US and Europe, whether it's residential real estate, commercial real estate, or consumer loans, you can see that, again, banks still play a major role. They're the largest lender. But again, as the demand for borrowing grows, as it just naturally does as population and the economy grows, banks just can't meet that demand. And what you'll notice actually is in Europe, a ton of this is in residential real estate. And so one of the big issues in Europe, just as a side note, is that Europe doesn't have the government-sponsored enterprises. They don't have Fannie and Freddie, so they don't really have a securitized market for mortgages. And so the mortgages just sit on bank balance sheets. And that's actually one of the major areas that is growing in private credit is financing mortgages in Europe because the banks just simply cannot do that. And so, again, as the banks are more restricted, you can see certain areas of the economy are naturally going to be restricted with that. One of the things that's happening in Europe in particular, though, is Basel IV or Basel III endgame. So we talked about regulation within Europe and the US really around the financial crisis, pulling banks back. We actually have a second set of regulations, clearly not going through in the US, but still looks like it's going to happen in Europe. And this is really the last leg of the financial crisis, post-financial crisis era regulation. And effectively what this is doing is it's just going to restrict banks more and make them hold more capital against a lot of these asset-backed loans. That's very expensive for banks to do, to hold capital against loans. And so we're beginning to see banks not only slow down in terms of their consumer lending in Europe, but even begin to divest, like sell portions to private credit managers of their loan books because there's too much regulatory onus. And so here, in a similar way that you would be interacting with one of those origination platforms, in this case, the opportunity set is quite literally to buy existing pools of loans from banks that just need to divest of risky loans because of the fact that they have, sort of a regulatory burden around that. All right, I'm going to stop for a second just to see if there's any questions before we go on. I mean, there's a lot of stuff we're going through, but yes.
Has there been any development of a default swap to cross-hedge the risk on private credit?
There is not, to my knowledge. I know that there are folks that will just use like liquid credit default swaps as a way to hedge beta at times. I mean, that's one option, but the markets themselves are not liquid enough, and to my knowledge, that anyone's created anything synthetic around it. I think the closest thing to that is you're beginning to see these secondary markets begin to percolate in not asset-based finance because it's newer on the private side, but definitely in direct lending. And so, as you begin to have traded prices that can be monitored, then you can begin to do things like that. So I would say that if you think about private credit 1.0 direct lending, it is slowly migrating towards something that's looking more and more like a public market every day. It's still private, you still get great premiums, but it is definitely migrating in that direction. With the asset-backed, really the only liquidity that you have there is to securitize and sell it off into the markets, which you can do depending upon what assets you have. But yeah, not quite liquid enough for a CDX, but good question, yeah.
What you just described sounds like maybe what happened in the leveraged loan market 40 years ago. Is that an analogy?
To some degree, I think that you say on the asset-backed side, or what you're saying, what's happening with the corporate credit? Yeah, exactly. It probably will. Yes, it probably will. And I think what's going to be interesting to me personally is to what degree do regulators come in to start to regulate some of the stuff if it's traded, because regulation is sort of, I think of it as a form of infrastructure. It sets the rules so you can begin to have things like markets. And so we don't have that sort of regulatory infrastructure, but it's moving in that direction. Listen, this is what happens when lots of people start to invest in a market, it becomes big, people start trading over the counter, market makers start to see that, and our business is very good at monetizing everything. And so, yeah, it's definitely headed in that direction for sure, yeah.
Where do syndicated bank loans fall out in your aggregates?
Sure.
Private versus bank loans, and do you have data on the term structure of the private credit versus the high yield market?
In terms of the duration of the assets, I don't have any offhand. That's a good question. It depends what kind of loan you're making. When it comes to the asset-based loans, they tend to be shorter in duration than the corporate loans because consumer loans and even the smaller business loans tend to be 5 to 7 years, and they're amortizing, so the average life is like 3 years, which is a proxy for duration, as it were. But the corporate debt, that's a really good question. If on average, it's a good question. I don't know the answer, but yeah. Oh, but the syndicated loan. So the syndicated loans and a lot of the original private credit effectively was going after similar markets or lower markets than the syndicated loans. Now what you have is, as these private credit managers, syndicated loans are usually the larger ones, not really the true mid-market, but as private credit ecosystem has gotten bigger, you've seen private credit managers move up and up and up in terms of the size of the deals. And now companies are quite literally, large companies are quite literally thinking, do I want to go to the syndicated loan market? Do I want to go to the public market? Or do I want to go to the private markets? And they themselves have options. So the higher end of corporate direct lending is absolutely bumping up against syndicated loans.
Is that market shrinking?
That's a good question. Is it shrinking? I think it ebbs and flows based on sort of, where it makes sense for these companies to finance. So if it becomes really expensive in the syndicated markets, you'll see more deals getting done in private credit, and then vice versa. If you see spreads coming down in syndicated markets, then they'll finance there because it's cheaper.
And that market tends to be low duration because it's all floating rates.
It's all floating rates, so it's low duration. Yes, absolutely. Yeah, so generally speaking, I guess if you have the self-amortizing from a pure duration interest rate sensitivity, absolutely. It's floating, and so it tends not to have one. But in terms of the term structure, that I'm not sure about in terms of the average term, but that's a good question we'll follow up with you afterwards for sure. Great questions, thank you. Figured we'd have to break up some of this material with some questions. All right, so thank you for those. So let's talk a little bit about I don't know, that's interesting. Okay, I don't know where that signal's coming from, so I apologize. Let's see if this is on the next one too. Yes, it is. I think. that this may be coming from this device. So I'm sorry, guys. I don't really know how to deal with that, so we'll just work through it. It'll be fine. Okay, so I think if you think about kind of going back to asset-backed, so again, in addition to working with these specialty finance origination platforms, buying debt from banks is another great way to do it. This is our expected returns for sort of assets moving forward. So we have our own Monte Carlo simulator, our own capital market engine that we utilize internally for our own private clients, where we take the current state of the markets and we take our own modeling and we kind of look at how different markets are likely to do over the next decade. So for direct lending, there are indexes that you can look at historically, as we did earlier. For asset-based finance, there are no indexes, right? So we're using our own internal data from our 38 years of doing this to model it out. And so, just to be clear, this is not guaranteed. There's a lot of disclosure language at the bottom. But this is our best guess, kind of given the starting yields today, given the kind of defaults that we've seen historically, and given our modeling, our expectations are that this should keep up with what private credit has done historically. If we think about global equities, I mean, they've had a great run for the last decade or so, but we think they kind of go back to normal, kind of 7%. If you dig under there, international looks a little bit better than it has over the last decade, US a little bit less. And then high yield, now that rates have reset, we think you're back to kind of a more standard 5.3% in terms of total return over the next decade. But our expectations are that private asset-backed should deliver something similar to what we've seen over the past decade for direct lending markets, which is high single digits after fees with, call it, 2/3 of the risk of high yield bonds. And I think that's important to understand about this. Like, I say this not to get excited about private credit, but just to temper expectations. I think sometimes folks hear private markets and they think double-digit returns, 15% returns, and all these sort of outsized returns. And I think credit is more about having high single-digit returns with less volatility. So I think it's important to be, mindful of expectations. Managers and investors can, inflate that in their own minds. But high single digits for us is the bogey on private credit. Private equity obviously is going to be in the double digits. So let's talk about implementation for a little bit. I'm going to talk for about another 10 minutes, and then we can open it up to Q&A. But implementation of private markets. So we have direct lending, we have asset, which is kind of the original. We have asset-backed, which is this burgeoning market. We think both are great asset classes. One is more institutionalized and sort of becoming a little bit closer to something that looks similar to a public market. Not quite there yet. Maybe in a decade we will. But it's institutionalized. It's easy to access. There's a lot of great managers. The other area is a burgeoning market. We think a ton of forward-looking opportunities, but it's early days. And so our best advice to investors is really if you're going to create a core allocation in private credit, is to just pair asset-backed with corporate lending in a 50-50. That's a great starting point to get a tremendous amount of diversification in a portfolio. You have corporate lending, which has high income. Oh, you're going to try to fix the... that's okay. Don't worry about it. We're all casual here. We're going to have a corporate lending, high income, really strong covenants to mitigate risk. You have really diverse exposure to the U.S. Middle market. And as I said, it's a well-established market. What we tend to advise clients on is to pair that with asset-backed, which is a little bit more total return. A lot of times in asset-backed, you're buying assets at a discount. So you get income plus the potential for capital appreciation. This is great. I'm going to stop from this, eating into some of my CE credit time. So we'll give you guys like a little break for a minute. It still counts. I'm up here and I'm talking, right? So the key characteristics of asset-backed are it's total return again, so you get a little capital appreciation potential. Obviously, we talked about collateral backing, which, by the way, doesn't just mitigate downside risk, but those assets underneath are typically tied to CPI. So if you think about a stagflationary environment where you have high inflation and large losses, your collateral is actually tied to inflation. So your downside protection is actually somewhat inflation adjusted. Diversified, incredibly unique underlying exposures. And then it's a growing market with macro tailwinds. So again, it's new. You have to be more careful going into those markets, but it's growing with macro tailwinds. And we think corporate lending and asset-backed together make a great complement or a great starting point for building a private markets exposure. One of the things to be incredibly mindful of, this might be the most important, if nothing else, I would say to take away from this, this is maybe the most important. when you invest in equities or you invest in high yield or you invest in core bonds, 95% of your returns are going to be from the beta, from the underlying beta, the exposure that you have in that market. And maybe 2 to 5% is based on how good the manager that you chose is. This market is totally different. So normally, a lot of folks make the argument that high yield, public high yield, should always be active because you can see that there's a massive dispersion, about 250 basis points between the best and the worst manager. And so a lot of folks use that to make the argument that you should always be with an active manager and a proven track record in high yield, because that's considered to be a lot of dispersion between the best and worst performing manager. If you look at private credit, the dispersion is so wide between the best and the bottom decile, right? You're talking about 15%. It's practically a different asset class. And so this is really critical. This is private credit, as much as it is becoming more institutionalized, is not a beta. This is not an area in which you invest in a manager and you get that beta plus or minus some alpha. If you invest in a manager that doesn't do well, it's doubly problematic because the returns can be very poor and you're stuck in the investment. I mean, one of the big things to consider about private credit is you don't get that excess premium and the lower risk for nothing. The cost of entry there is giving up liquidity. And if you pick a bad manager in an illiquid market, that is the definition of tail risk. Or we were talking about it earlier with a professor over here, kurtosis, which is like statistical tail risk. That is so large in private markets because the manager's stuck in their investments and you're stuck with the manager. So what we would say is that as important as it is to understand the market itself, it is critical to do your due diligence and to go with a manager that has experience and that you feel has proven that they can continue to generate the types of returns that are expected in this market. Because again, I talked earlier about the historical returns being high single digits. That's the average manager. If you're in a bad manager, 2.9% and a lockup of multiple years is not something that's going to make most investors happy. So I think when it comes to implementation, manager selection is critical. In fact, it almost doesn't matter which part of the private markets you go to. It's more important that you get good managers in each of them. And so I also like to say that you don't have to own every private market to benefit from this. You just have to own enough of it in your portfolio. So what about sourcing? So in terms of sourcing the private credit allocation, there's a few ways you can source it. The easiest way to source private credit is from public credit. And that sounds obvious, but there's a few reasons why. Number one, you're effectively having similar underlying credit exposures, but you're increasing your yield and lowering your volatility and lowering your probability of a 20% loss, which is a little bit different than its tail risk. But overall, you're lowering your risk while you're raising your yield. The other thing, the reason that's great to source from high yield is one of the big challenges in investing in private markets is rebalancing. So if you're rebalancing a portfolio on some regular basis between stocks and bonds and other types of investments, normally they're liquid and you can just rebalance them. But if you're in a structure, like a private credit structure that you can't always sell, then rebalancing can become more challenging. And so if you source it from a public high yield, you can think of your entire credit bucket as one allocation, and you can rebalance from the liquid high yield. It adds a bit of a buffer to it. And we think that that's a very practical way, but a very simple way of doing it. There's a few other ways that you can think of sourcing private credit, and it really is based on what you're looking to do with your private credit allocation. A lot of folks like to just source it right out of public fixed income, so take some from rates and some from credit. If you do that, you're going to increase your return, but you're not going to lower your risk as much as you would if you're just allocating from credit, right? Because you're allocating from both high quality and high yield bonds. But you can use it as a proxy for that. There are a lot of folks that haven't done private markets, and they're really looking to just slot some sort of private allocation alongside their more traditional 60-40. And you can actually use it this way as well, where you actually think of it as a private market allocation, and you source it from bonds and equities, and you end up with the kind of what's talked about a lot recently, which is the 20-30-50. That's many have called that the new 60-40. And in that case, again, you're increasing returns, you're lowering vol, and you're lowering the probability of a large drawdown. And the final way that we see people using private credit is as a proxy to equities. And in general, credit's a nice proxy for equities because you can get similar levels of return with less volatility, especially with private credit where the premiums are such that you're getting effectively the same historically level of return as equities with lower risk. And later in the cycle, we see people kind of doing this more so than earlier in the cycle. So later in the cycle, high valuations, we think that private credit can actually be a nice way to lower your overall volatility as an equity proxy. And again, there, you're going to increase your return, lower vol, and reduce your probability in our expectations, as it were. Final thing to think of, I apologize for the word salad on this. I couldn't think of any graphs to show this, and we can get you the presentation afterwards, is choosing the right vehicle. So private credit, as I said, is an illiquid market. You can't just invest in it in a mutual fund because folks cannot buy and sell it on a daily basis. There would be a massive mismatch between the underlying investment and the vehicle that you're utilizing. So you have to have a matching of that. There's a few different ways to do private markets. The first is the kind of original ways that were, which is private limited partnerships. These have multi-year lockups. They give the manager full flexibility. The IRRs tend to be rather high, but they come with a lot of constraints. Number one, you have to be a qualified purchaser. So that's something like $5 million for an individual and over $20 million for an institution. And so the qualifications are high, and also you're locking your money up for multiple years, and you have to manage the cash flows. You're getting cash called at irregular times. So, and the tax purposes for a lot of individuals, K1s, people are sort of bearish on the structure, but it is the purest play, the purest way to get access to private markets, and it's great for those that can do it. What we've seen over the past few years are these sort of semi-liquid structures of non-listed BDCs, tender offers, non-listed REITs and interval funds pop up. And I'm not going to go through each one of these, but these are semi-liquid structures, and each of them are similar in that they have to be able to redeem 5% of the total fund every year. All right, so what does that mean? That means that if every investor comes to redeem their assets, and there's been some large ones in the news, it may be that one of these funds puts up gates because you can only sell so much of your assets if you're invested in private assets. In fact, what you see in these semi-liquid funds is what they do is they pair public assets and private assets together to meet that liquidity. And so what that does effectively is it does reduce that liquidity premium we're getting. So if we looked at 300 basis point liquidity premium earlier, and now you're adding some publics so that you can meet those redemptions, you're naturally going to slightly dial down that liquidity premium or the return expectation. So that is a little bit of a give up. What you gain by doing that, especially in the interval fund structure, is that anyone can buy it. Anyone can buy an interval fund. You don't have to be an accredited investor, and you can buy it on a daily basis in most cases. And on a quarterly basis, most of the time, you can redeem your shares. And so it offers more liquidity, and it's a nice balance, a lot of these semi-liquid funds, between a mutual fund that's liquid every day and can only hold 15% illiquids, and a private partnership that is 3 to 7 year lockup based on what you're looking at, 2 to 7 years nowadays. And so this is an area, the interval fund is a really popular area. You see lots of managers offering interval funds, and the reason is that it's just extremely accessible. So again, I'm happy to answer questions on structure, but I'll just end with this and then we'll open it up for questions. All right, so if we think about private markets, at the end of the day, private credit we still think is an incredible asset class. Private credit 1.0 was really about banks stepping away from direct lending to private equity sponsored companies. That market's a great market, but again, it's become somewhat crowded. But we still love it as a core holding. What we think is really exciting, and we would encourage all of you to dig more into, is the burgeoning asset-based finance area, which is private markets coming in and financing things like the consumer. We see that area growing tremendously, and we think that, frankly, it's incredibly exciting. And pairing the two of those makes for a really nice way to get into private markets. And so we would say first you want to assess the opportunity set for yourself or for your clients. We think it's incredibly important to consider liquidity preferences of a client and understand which vehicle is going to be best for them. Do they want the pure play or do they need more liquidity? Designing the allocation, we talked about multiple ways to source the allocation. You can source it from public credit, which makes rebalancing a little bit easier, but you can also use it as a proxy for your fixed income, as a private slice in a 60-40, or a way to de-risk your equity. So a lot of different ways to use this tool, which is rather high Sharpe ratio. Obviously, selecting managers is critical. Again, it's almost less important whether you do direct lending or asset-based finance or private equity or any of these things. It's most important that you choose a good manager because, again, I think the biggest risk to all of you as investors or advisors is that you choose the wrong manager and that you're giving up that liquidity. So again, you are stuck with the manager that you chose. So the due diligence piece is more important in this space than anywhere else. And then finally, like I said, determine your sourcing. So where are you going to source it from? Do you want to enhance your returns, enhance your income? Do you want to mitigate your risk, or do you want diversification? And based on that, that will tell you where you source it from, which is, again, high yield, credit, a fixed income broadly, a balanced portfolio, or equities. All right, so that was like exactly the amount of time I needed to talk for you guys to all get CE credit. But yes, questions, please.
Brian, can you give us a picture of the landscape of the overall playing field of who the managers are, who the AllianceBernstein competitors are, who the investment bankers,
Yeah, sure. So it's
who the servicers are?
100%.
Who's playing?
So it's a massive landscape on all of those fronts. That's the right question to ask. I will say that you have a mix. So like AllianceBernstein, we own a firm called Carval that we purchased. They were $20 billion shop that just did this. We saw this as a growth area, so we purchased that company, brought them on board, and now they're sort of doing that. So we see a lot of other large money managers doing similar things, going out and buying what were these kind of niche hedge funds or private credit managers, whatever you want to call them, that were situated in a market that's been around for 40 years, but it's been small, and now it's exploding. So you see managers picking up expertise, something that we're also doing to add to our ranks. You mentioned investment bankers. We're hiring folks from Goldman. We're all hiring investment bankers as well to build these out because, as I said, it used to be banks financing this stuff, and now it's private credit. So you have the investment bankers moving from investment banks to private credit managers. And so I would say all the major money managers are doing this. It's really interesting, though, to see the approach of some of the managers that are more traditionally private equity coming into the space versus traditional managers coming into this space. And there are definitely some nuances, like you see some of the private, so we talked about those specialty finance platforms. There's a lot of these independent specialty finance platforms that companies will partner with. Some of the big private equity firms just want to own a platform that feeds the beast. And so you have this sort of relationship where the private equity firm buys a platform and that platform feeds the private credit strategy. And so I think there's pros and cons to both. But it's all the major money managers are starting to build out capabilities to do this because we all see this as clearly, it could easily be one of the largest, probably is going to be the largest credit market by a long shot because, consumer credit in the US, when you include housing, is like a $17 trillion market. So it dwarfs corporate credit. And we think it'll probably continue to move in this direction. In terms of the platforms that are issuing the debt, it's a mixed bag. You have some really large platforms. These are probably firms that we've never heard of, but finance a lot of our debt out there in the US and Europe. And then what you've had, and this is where we think it's really exciting, is some of these more specialty players. So we talked about like power sports. There are some firms that focus just on power sports lending in like the Southwest, right? Very specific. They understand their demographic. They understand the collateral. They have relationships with dealers. And they're building their own little ecosystems. And we find those to be very interesting because they have a harder time getting financing and they are great at issuing really interesting debt that has high yields. And again, they understand the underlying. So you do have some of those, although, and this is a plug for my podcast, Unconventional Capital, if anyone wants to learn more about this, I'm trying to get above 200 followers. So if like 10 of you sign up, I'll get there. But we talk a lot about this, how it's sort of, you have to underwrite. The job of the manager in this space is to underwrite those platforms, to understand who you're doing business with, and to put covenants in place to make sure they're feeding you the right debt. And so it's different than traditional money managers where you're just going out and making an investment. These are always partnerships. And so developing those relationships and underwriting those platforms is really complex and difficult. Again, it's sort of very specialized knowledge. We think one of the biggest risks in this space are some of these newer platforms that have gotten venture capital to go out and loan money to some risky part of the market. And they're just raising equity. They're not even having good unit economics on their loans. They just keep raising equity and make more loans. And then you have newer private credit investors who are thrilled to get any deal they can financing these folks. And we think so the newer entrants are probably the area where you get the most risk, but it is so diverse across the board.
Yeah, just in terms of dry powder, could you scale that relative to the opportunity set where you see this now?
Yeah, sure. So what we would say is that I don't know what the dry powder is on the asset-backed side specifically. On the direct lending and the private equity side, there's a tremendous amount of dry powder. I think the dry powder on the private equity side is a good thing for private credit managers on the direct lending because it should, in theory, imply that more deals are coming. But as private equity deals slow down, it creates a lot of issues for direct lenders because there's just less deals to be had. And so that is an issue right now, is dry powder on that side. On the asset-backed side, we would say that the demand for capital massively outweighs the supply of capital right now. So these are the dynamics you want as an investor, is that you're investing into an area that needs liquidity. And so there, it's hard to size the market. We would say the underlying market right now is getting close to, kind of between that $6 and $9 trillion in terms of opportunity set. But again, that's still parsed out between banks, investment banks, and money managers. But as that grows, money managers are gaining share. So right now, we would say there's still a supply-demand mismatch on the asset-backed side in terms of you want to have capital to provide. On the direct lending side, there's a lot of dry powder, and part of that's just because deal flow has slowed down. Yeah.
Yes. You had a slide showing the volatility between high-yield bonds and private credit.
Yes.
In your opinion, what percent of that difference is accounted for by the fact that private credit doesn't price daily?
Definitely some of it. It's hard to say. Yeah, definitely some of it for sure. Well, it's actually really funny because I had a conversation with ChatGPT yesterday about this. I was just curious. I call it she because I think of it as a her. Mine has a female voice. But what she told me is, because I was asking her, I was like, listen, I was like, some of these funds out there have zero volatility. That's where I get really cautious. When you look at a fund and it's been around for like 6 years and the NAV is just like literally zero volatility, can't be right. And so I think, if you think about the underlying risk, I think some of it is, yes, mark to market, but at the end of the day, these loans do perform better. So some would also say that the volatility in high yield is a little bit overblown. If you look at for us, the real risk is in this underlying here. This is what really matters. So the question is, are these less risky? And if you look at the loss rates, so defaults in high yield are about, call it 3% with about a 50% recovery rate. So that means you end up losing about 1.7%. Just as a side note for all of you, if you ever want to know what your high yield bonds are going to return over the next 5 years, take your yield to worst and subtract 1.7%, and it is eerily accurate. And it makes sense because you're being promised a certain amount of money. You're going to get some defaults, and it typically ends up being something like this. In private credit, and we can measure this, it's about 0.5. So it's about a third of the overall loss rate in terms of the underlying assets. Now, there's some leverage applied, and there's costs associated. So this is sort of the unlevered underlying asset. And so as you have cost and leverage and other things applied, this naturally will move up slightly. But again, you end up with about 2/3 of the risk of high yield after all is said and done. And the underlying assets do have, again, higher recoveries. And that's because you have these directly negotiated terms where you can kind of have recourse. What I was talking about earlier is that spreads were historically about 3% above high yield. Today, they're about 150 basis points. So clearly, spreads have come in. And this could easily, be higher as we get covenants a little bit lighter at this point in the cycle. Does that mean you shouldn't invest in this? No, it's like, the end of a cycle, you still own equities. You don't sell 100% of your equities. You may just not add to your equities at that point in the cycle. So I think that's really how we're thinking about it. But yes, some of it is mark to market, but the underlying risk is significant, is actually less. Yeah.
I assume that high yield number goes back through several market cycles, whereas that
Yes.
credit number really hasn't been around in a real deep downturn.
Well, yes. I mean, you do have 2020 and you do have 2022, but yes, there's no financial crisis that's going through. Absolutely. It's starting in really 2010 when you get the data. So you're right. Yeah, it hasn't gone. It has gone through COVID and the rates rising, but that is the question: is how are some of these things going to do if we get a real crisis? And I think it's really going to come down to the covenants that the managers have in place and the underlying companies they're investing in. Which is why I keep coming back to it's really about the manager and the deals that they're doing at the end of the day. Because you're stuck in those deals. If you hit a financial crisis, you want to make sure you have the covenants or the assets, if it's an asset backed, to really back those up? These are fantastic questions, by the way. Thank you. Yes.
Follow that difference between private credit and high yield. Is private credit winning on loss given default or default rate, do you think?
It's both. So the defaults have historically been lower and the recoveries have been higher. So it's actually both. So this is loss given, this is total loss, right? So this is loss given default, but in aggregate, so your total loss rate, yeah. Good question, yes.
Talk about the importance of manager selection. Is there anything that y'all see like that separates maybe the process that separates the good managers from the bad?
Definitely like ones that have been doing it for a while versus new entrants. I mean, one thing our business does really well is create products around fees when they're high. And you can charge really high fees for private credit. So why wouldn't everyone want to have a private credit offering? That doesn't mean they're good at it. So I would say number one is you want to dig into their track record. And I would say, a lot of times folks will show you a particular fund, but you should look at all their funds and how they've done. So I think that's number one, is get as much data on a manager. And I mean, for us, for instance, like for us, when we go to one of these origination platforms, so we are a manager, but I would say we look at loan level deals going back to the inception of the platform. No matter what it is they've ever done, we want to know how well they've done and where they've made the mistakes. And that's another thing. Again, just a little plug for my podcast. One of the things I ask is like, where have things gone wrong? Because a lot of managers, listen, I've been in money management for 25 years, and I've worked with a lot of portfolio managers, and they like to tell you about all the things that go right, and they don't like to tell you about the things that went wrong. And so I think the other thing is when you're doing due diligence, ask them what's gone wrong and what they've learned from it. And if they don't give you an answer, then they're hiding something and it's silly, or they haven't made a major mistake, which I'd also be concerned about, because how can you get better if you haven't made a major mishap? And that just comes with time and experience. And so I think it really comes down to like the first thing should be an experienced manager in the space. And the second thing should be look at everything they've done, not just the thing you're looking at, because that'll give you some questions to ask that as money managers, we don't always want you to ask. But that would be my recommendation. And sorry to any of the sales reps that are in the audience. Yes.
Brian, on Tuesday, 2 days ago, if I recall, the Wall Street Journal on the front page had an article about J.P. Morgan wanting to get into the private credit business.
Yeah. There's also an article about how much they think it's terrible.
Almost $2 trillion, but he's talking about Jamie Dimon, just the $50 billion piece, a small piece, he thinks may get in trouble, which is just your normal fall rate.
Sure.
He's going to have a program to clean that piece up.
Of course he is.
So what do you think of it?
I think that sometimes as business, we talk our books in terms of like, this thing's bad, but what I own is good, right? So I think there's an element of that. I've worked for many managers that got on Bloomberg and talked their books. I do think that you're going to get, I think there's a lot of money's chased this space. I think there's a lot of managers that are newer entrants or just large managers that just have to put money to work. I think you have a lot of public BDCs, and the BDCs, we talked about the structures before, the whole concept of a public BDC is fill it up with debt and then IPO. And a lot of that stuff is very questionable. So I definitely think that you're going to have, I think, you ask about a crisis. I think if we have a real downturn and a real corporate credit crunch, which we haven't seen in a very long time, you're going to see that dispersion between the good deals and the bad deals. There's definitely some deals that are going to go sideways. And I think, when the tide's rising, everyone looks good, but you'll see when the tide goes out who's wearing their swimming trunks and who's not, right? So I think that there's some truth to what he says. I also think maybe talking his book a little bit,
But he's just talking about the small piece of it.
Of course. That's going to blow up and then they'll capture, yeah. Well, if it does, then he's ready to capture it at a discount. That would be good for him. But I don't think that he's necessarily wrong. I think there are definitely pockets of frothiness in the traditional private credit market. Again, not so much in the asset-backed finance, but certainly in direct lending, yeah. Did you have a question?
I guess a recent trend seems to be a migration from traditional drawdown funds to evergreen funds.
Yeah.
It seems like it solves some problems, creates some others. I'm curious to get any comments on it.
Yeah, I think, listen, at the end of the day, the evergreen funds are fantastic, but you're going to be giving up some liquidity because giving up some of that liquidity premium, and you just have to recognize like you're not going to get the full benefits. And so it's just a matter of if that trade-off makes sense or not. And I think it does for most people. I mean, listen, if you're going to get 75% of the benefits of private credit, but you're able to, buy it on a daily basis and sell it most quarters, Again, I mean, frankly, if like a fund's not doing well, probably the worst time to sell it anyway. Investors don't want to hear that, but I think I think it's a nice balance for most investors. And we're actually seeing a tremendous amount of institutional investors. That's what's surprising to me, is how many institutional investors are moving more towards the interval fund, because it's just easier, or even ultra high net worth clients because of the tax benefits. And so you get tax benefits in terms of 1099 versus a K1, which a lot of folks like. That's a benefit. You get the benefit of significantly higher liquidity, and you get the benefit of more access. But again, you have to have liquid assets in there to some degree. So you are going to have a little bit of a watering down of that liquidity premium. And I think when you're doing due diligence on a manager in like an interval fund, for instance, you just have to make sure they're actually buying private markets. There's a lot of interval funds out there that are just levered high yield. In an interval fund, they say it's private credit, but it's not really. So you have to be very careful about looking under the hood with interval funds, because there's a lot of what I call, faux privates. If you just lever up public credit and put it in an interval fund, it's not necessarily private. It's just, levered credit. And that's a fine strategy. I actually love levered credit for myself. That's a fine strategy, but it's not private credit. So I'd say one of the other dangers is a lot of managers aren't doing what they say they're doing. So I would say the due diligence piece is important there too. But I think generally speaking, they're great. I think the world's going to continue to go in that direction. I wouldn't be surprised if at some point folks just own interval funds for their credit, and it's just a mix of public and private, and that's it. Yeah. Well, we've reached the 60-minute mark, so you all officially have CE credit. Thank you very much for your questions, and I hope you enjoyed it. And we can always follow up with materials and anything else you need. But really, thank you so much for the time.
Thank you.
Yeah.
All right, so how can you learn more? So if interested, we have a white paper out front that digs deeper into this topic. It goes with the presentation. Brian and his team are always putting out thought leadership and content, so we're happy to get that over to you. I also included my business card up front. So if you'd like to have a deeper conversation to talk about the space or some of our capabilities, we'd love that opportunity. If you have the form for CE credit, please leave it up front. We're going to put that through for processing. Any questions, anything you need at all, please don't hesitate to reach out. Thanks for having us.